Okay, oil prices. And we have been seeing this inflation figure brought about by higher oil prices and higher rice prices. Um, in terms of the price of rice, the government is doing something about this. I think the rice tariffication bill, once it's passed, definitely can bring down the price of rice in the market. And definitely that contributes a big part of the core inflation basket, rice. However, oil is something that is beyond the control of the government because it's being dictated by um, geopolitical uncertainties in the world market at the moment. The next thing that we are watching out closely is, as oil prices continue to move up, the next wave of concern would be wage hikes and transportation hikes. And this would definitely move inflation higher from where it is at the moment. And on a year-to-date basis, we have seen the inflation figure for the Philippines to average about 4.7%. And clearly, this is beyond the 2 to 4% range of the government. And last week, the recent pronouncement of the BSP, they're looking at an average inflation figure for 2018 at 5.1%. So it means that they are still seeing inflation to continue to move higher in the next 3 months. As average is this 4.7, or for it to hit 5.1, you need to see inflation move higher at the moment. So clearly there's still a lot of threat on inflation brought about by oil prices and the high prices of rice. And I think in the recent typhoon, we haven't seen the effect of that yet because that would have a lag effect in the market. So the BSP will continue to be hawkish in terms of how they move for their policy rate. So after the 150 basis points increase, we might still see one more rate hike sometime in the fourth quarter, just to be ahead of the curve and to be more aggressive. And it has been taken positively by the market in the recent change of stance by the BSP. Okay. And speaking of oil, the recent rally of oil from hovering about $60 per barrel now to last night is about $82 per barrel. It was really brought about more by the US sanctions on Iran. And it's more geopolitical than anything else. Previously, we have been banking on shale oil. That's why even the government has been confident to say that oil will never surpass 60 because shale will start kicking in. Remember, shale oil is being produced in the US. But the problem is, the US could not transport shale oil. And they don't have much investments yet on pipelines to transport it, unlike in the Middle East and in Europe where the pipelines are already established. Here, it's just that they're still building pipelines on how to transport that shale oil. If you look at the world market and price for shale, it still remains at about $50 per barrel. So in the near term, it won't really bring down oil prices because of that supply. It will still be more dictated by tensions in Iran, and hopefully the OPEC can agree to increase their production. That's the only way to bring down oil prices. And we probably can expect that to happen sometime early next year. But probably towards the remaining months of the year, we would expect elevated oil prices to continue. That's why we will see gasoline prices to continue to move higher. in the next coming months, especially as demand starts picking up towards the Christmas season. Okay, more on inflation. Weather disturbances, the recent weather disturbances clearly will move inflation higher from where it is at the moment. The supply bottlenecks, the supply problems and vegetables will definitely eat up inflation expectations. And as we increase inflation, definitely growth will start to be challenged, at least in the near term. The next wave is the transport and wage hikes, which we still haven't felt the effects of. That's why the government, or more particularly the BSP, it's really more of forecasting inflation or inflation expectations, because the last thing they would want is to have that sense that inflation will continue to move higher. If that is the forecast, then you'd see the wage boards starting to lobby for higher wages. The transport sector will start to lobby for higher transport fares. And that will start adding more to prices of the basic goods and services, which will exacerbate an higher inflation in the next coming months. So clearly the BSP would continue to be very aggressive in terms of how they will curb inflation by increasing short-term rates and working closely with the government on how they can normalize price of rice in order for that perception of forward-looking inflation to taper, to go down. And if they can be successful in doing so, then we can see lesser concern on higher wage prices and higher transport prices moving forward, which can greatly affect inflation. Okay, on oil, as I mentioned, next year, even if we see elevated prices to continue in the next few months, we expect oil prices to revert back probably to near the 70 level, as following consensus views that and forecast that oil will start tapering back to their long-term average by probably mid-next year, towards the 70 per barrel level, or even clearly near the 60 per barrel level. So hopefully by next year, we can see a more tapered inflation forecast for the market as driven by oil. And if the government starts to implement the rice tariffication and normalize supply of rice, then we can further see inflation tapering. The next concern is the peso. And we have seen the peso depreciate against the US dollar by about 8% since the start of the year. Again, for one, it has affected inflation as well, because we're a massive importer of goods, commodities, and it becomes more expensive if the peso is weak, as we pay it in dollars. And likewise, the immediate effect of a weakening currency is in the equity markets. We have seen a lot of foreign funds exit and lock in their gains because they don't want to be eroded by a further currency weakness. Because they always start with dollars, and even if they continue to earn, as the peso depreciates, their earnings continue to erode. And that has triggered the sell-off in the Philippine equities, since probably we have seen the peak of 9,000 and slowly, together with the whole emerging markets correcting. But in particular, if you look at the Philippines was one of the few countries where the currency has weakened significantly. And part of it, as you have been hearing in the past, is clearly our current account deficit. We have been running a current account deficit, meaning more importation than exports. And rightfully so, because most of the imports that we're doing are capital goods, equipment, in order to fund our growing economy. However, this has a short-term effect on financial markets and inflation in particular. So clearly, the other contributors of the sources of dollars, where BPOs has been quite stagnant, OFWs are growing at a steady pace. So it's not as if before that we are confident to see that these two strong contributors of dollars have been or can offset the massive importation bill that the government has been experiencing. So next slide will show you where the peso is compared to the other world currencies. So we're one of the worst performing currency as of year to date. But hopefully that can reverse next year. And our gross international reserves has been as it has been dwindling from a high of about 83 billion. Now it has gone down to about 78 billion. Part of this was the BSP was active in the market trying to defend the peso. And if you notice the line represents the import cover, meaning how many times we can pay for importation. And it has gone down as well because obviously we have been importing more than the original source of dollars. It has gone down from a high of about 12 times import cover, and now it's just about 7.5 times import cover, or months, sorry, import cover. So we can only pay about 7.5 months. Previously, it's about a year's worth of importation. So we are importing a lot, and this has been affecting the peso. But most of the importation are going to capital goods, as I will show you in the next graph. Here's an interesting graph on remittances plus trade balance. Previously, in the last few years, if you add all the dollars that flow in by remittances, BPOs, it continues to be positive and offsets any import bill. But as of 2018, our importation bill is even higher than the contribution of dollars that goes into the system. That's why it's eating up on reserves and it's eating up on our current account. So if we continue to have this trajectory of growth in the market and we need to import more equipment, then that would probably be more of the new normal as what we have seen in the previous years. And just a breakdown of what is our import bill. Largely, it's about capital goods for infrastructure and capital expenditures. So, in the short term, definitely, we would feel the brunt of this as probably translated by weaker currency, but we're investing for the future. The government has been continuously importing, companies are continuously importing equipment for further expansion. But in the short term, definitely we would see some negative effects of this. Okay, so that's quick overview of the economy. This is the Philippine equity market. And from the peak of 9,000, you see it from the chart. We have been trying to move within a 1,000 point range. As I mentioned a while ago, we saw the market attempt to break 8,000 from July, August because there was some buying in the market. But now, it has corrected again. We're nearing towards the 7,000 level. So, again, it's a make or break on where the market is. We can see it move higher or worsen by breaking 7,000. If it breaks the recent low of 6.9, then probably we can see a new trading range lower. But as of the moment, we can continue to see it just consolidate because there's still no definite catalyst that can really push the equity markets to recent highs, at least in the near term. But we continue to see all the positive effects that the government is doing, which can translate to higher markets down the road. But immediately we won't definitely see this being translated in higher markets. Okay? In terms of valuations, if you're an equity investor at the moment, now is the right time. You see it in the graph here that the ones that we've encircled in red are the times in the past where we have seen the Philippine equity market at its cheapest level. And at its cheapest level, it usually bounces back. So if you're an equity investor, I think now is the right time to start accumulating at cheap levels. And we have seen this in the past where most investors are more confident to buy and participate in the market during rallies. But nobody wants to buy when there's a weakness in the market. And right now we have been seeing weakness in the market, and I think the weakness will probably be prolonged for some more time. So for investors, it would be definitely a good opportunity to pick your spots rather than start chasing markets when it's already higher. So it's an opportunity for us to again just pick our spots and not chase and be overwhelmed when the market is rallying again. And at the moment, we can see markets for a potential rally if just one or a few big foreign funds start entering back in the country. Because at the moment, we continue to see selling from foreign investors. If that selling stops, and definitely we can see markets continue to rally back up again. So just to summarize again, we can probably see more negatives in terms of the economy before we see positives, and that will be translated in financial markets as well. So in the near term, we won't expect markets to rally anytime soon, but that won't stop investors from investing and picking their spots on where, on when to invest. The tailwinds, the long tailwinds that we are expecting is the infrastructure push of the government. And infrastructure investing takes a lot of time. It doesn't happen 1 year, 2 years. It takes several years from construction to implementation. So if you believe that the government will be able to deliver, definitely that's something that can spur up growth for the economy down the road. The change in stance of the central bank, or the BSP, has become more positive, and it has regained back confidence that the BSP is in control of inflation and of interest rates, and that has added a strong feather to the BSP on how that they would view, or how foreigners view, the central bank. There's the large IPO that we're expecting in November. This particularly is the San Miguel Pure Foods deal, and it's about 150 million US, and half of that will be sold to foreign investors. So we would expect inflow of dollars to come in by next month, and that will definitely strengthen the peso together with the seasonality where OFW remittances will be heightened towards the last 2 months of the year. So we would probably expect the peso to strengthen from where it is at the moment because of these things. However, on the headwinds, which we always have to consider, the US will continue to raise their interest rates. So all markets together with the Philippine market will have to adjust. And if you are an equity investor against a fixed income investor, it would now be a more difficult choice between investing in equities or investing in fixed rate instruments where at the moment rates are becoming more attractive as opposed to the volatility of the equity markets. The strength in the US economy cannot be forever sustained. It is still at all-time high levels. So we would probably expect some correction down the road where from developed markets, the funds might consider moving back to cheaper markets such as the Philippines. The continued peso weakness will definitely dampen sentiment, especially if you're a foreign investor coming into the country, as definitely it would erode any earnings gains from any financial instrument. The trade war, the uncertainty of the trade war and how it will affect countries in Asia will continue to be, will cast a shadow towards Asia and probably the Philippines. But anecdotally, we have been seeing and hearing some positive news as an effect of this, where some of the manufacturing were being channeled to the Philippines because from China, if anything goes out of China, it will be taxed in the US. But there are some companies where they're moving manufacturing to some Philippine partners because if you import from the Philippines, it won't be subject to tax. So that is something that we are watching out closely, and this will definitely add more to the growth of the manufacturing sector. So again, there will be more negatives before we see positives in the economy, but it doesn't mean that there's no opportunity for us to enter markets at the moment, because as an investor, we like entering markets when they're cheap and when we can pick our spots rather than trying to chase it when it's already moving higher. So the last slide, I will just leave you with our macro forecast, our house forecast, particularly I encircled 2019. But for 2018 first, GDP, we're expecting GDP for the year to average about 6.4%. This has been adjusted lower from our original 7% forecast. Our headline inflation for the year will average about 5%, which is probably close to consensus, but the BSP has made pronouncements about 5.1 for them. But take note, for 2019, we expect inflation to normalize back to 4.1%. So that will move down inflation significantly from what we're seeing at the moment. In terms of the FX, the dollar peso at the bottom, we expect the peso again to close the year near the 53.80 level, as because of the factors of OFW remittances coming in and potential large IPO to come in by November, and further strengthening come 2019. So I think those are the more important forecasts. So 2018, probably we can see markets where it is at the moment, not much movement from where it is at the moment, but there would be more brighter prospects for 2019 moving forward. So with this, thank you very much for your time.